Hello everyone, this is Carbonomics. We've had a trend over the last 5 years or so, especially before the energy crisis and supply chain issues began, of investing in disruptive companies. The Cathy Wood approach to investing, right? In this video, we'll go over why this investing style is pretty difficult to succeed in under any economic circumstance besides a pretty bullish frenzy, like we had until the start of this year. But just take a look at some of the companies Cathy Wood's focused on. Zoom, Tesla, Roku, Coinbase, DraftKings, Roblox, Robinhood. Many of these companies are in high growth industries, attempting to disrupt a previous system. Tesla being the most obvious example of this, being one of the first movers in the electric vehicle space and taking, pretty significant market share from the incumbents. But what's wrong with this focus? Well, one of the main issues was that all these companies were extremely overvalued. But that isn't necessarily the company's fault. The markets were in complete mayhem. The issues in that it's extremely difficult to figure out who could potentially win in these markets. There's far too many competitors. DraftKings in the online gambling space is a clear example of this. Not only are these purely online players emerging to take market share, the DraftKings, FanDuels, there are also the physical players competing as well. MGM, Penn Gaming, the list just keeps going. How's a retail investor ever going to figure out which of these companies will ultimately hold, the most market share or the few dominant players? You could easily have a scandal or some reason to switch platforms emerge. There isn't really going to be much brand loyalty there quite yet. If an average investor wants to figure out what the leader of an industry would be, it's probably at the point where, there isn't a lot of money to be made anymore anyway, if it was quite obvious. And many of the companies, people like Cathy Wood focus on are large caps with, tens of billions of dollars in market cap. I don't know all the companies on this list, but for many of them, they're in the same situation DraftKings is in. And last I looked at the online gambling market, around 2 years ago was when I really followed it closely. DraftKings was one of the primary leaders, and the company is still burning cash at this point. And I mean, to achieve its dominant position, Tesla nearly went bankrupt several times, as Elon Musk admitted to, and they could have easily failed. Markets like these are evolving, too rapidly to predict with any real accuracy, in my opinion. And Warren Buffett had pretty famously avoided tech stocks until, buying Apple pretty recently. And it was because these markets are just changing too quickly to be certain a company has a sustainable moat. Oftentimes the most popular stocks are actually the worst ones to buy. Although Buffett is forced to give in and buy these companies, now simply because his portfolio is just so large. But for the average retail investor, if you're going to focus on investing in truly disruptive companies, it shouldn't be in an industry that's growing rapidly, in my view. Money is significantly easier made in companies that are improving a process in an otherwise boring industry, or buying and consolidating typically non-standardized assets. And there's no better example of a company revolutionizing a traditionally slow and boring industry than a company that I'm a shareholder of, Abaxx Technologies. Abaxx's goal is to bring new technology, blockchain, digital ledgers, and other advanced market infrastructure to the commodity exchange space. Although that is more of a long-term goal currently, as the company's primary focus is building out a physical commodity exchange with a new benchmark contract for liquefied natural gas, which has a total addressable market of around $500 million. So not the largest, but there is essentially no competition if Abaxx does launch a successful contract. And if they take around half of that market share or more, that's a multi-billion-dollar company right there. And Abaxx currently trades at 130 million market cap USD. This opportunity exists for multiple reasons. One being the LNG market has traditionally been traded on long-term contracts, so there was no real need for a spot market or a market of last resort. But that's changing pretty quickly. And the other reasons that CME and ICE, already have existing contracts that are only financially traded. So firms can hedge their natural gas production to some extent, but they can't physically take delivery of LNG. Financially settled contracts are going to be, less expensive to create, as you don't need that infrastructure for terminals for commodity delivery, or storage factories, um, or other real infrastructure like that, as I mentioned. And the large exchanges already have, those existing financial contracts, and they really don't want to take liquidity away from that. So they're not really incentivized to create, a physical contract for LNG like Abaxx is. So Abaxx is really filling a natural void, with little competition since they're going after, smaller and emerging market verticals for the time being anyway. Specifically LNG, carbon, and battery metals, which can make a significant difference for Abaxx in terms of revenue, but it wouldn't necessarily to the same extent for the larger exchanges. Although they could be huge contracts later on, especially as the world moves towards net zero emissions goals. So the existing players in the space have grown pretty complacent. The Indian Stock Exchange and the B3 exchange in Brazil are technically larger, but CME and ICE are the two dominant commodity exchanges by volume. Abaxx has an instantaneous advantage over them, because they are far behind technologically, and the entire financial industry in general, to be honest. And it wasn't really that long ago that they all really transitioned to the cloud to begin with. They never dream of integrating blockchain technology like Abaxx is currently working on. This isn't to say that Abaxx is planning to compete with them on all their existing, futures commodity contracts, but the potential is certainly there, later on, if Abaxx wanted to. And there's really little that they can do to drive Abaxx out of the industry at the moment, because it can certainly take years to develop physically delivered futures contracts. And it took Abaxx 4 years to build out the LNG contract, as the company's hoping to launch their exchange, Q1 next year. And how many of these disruptive companies that Cathy Wood's invested in, how many of them could pretty certainly achieve a majority of the market share in a market, if their product launches successfully? Because that's the situation Abaxx is in, and I'm willing to bet that, most of those companies are not in the same boat. An LNG futures contract could not be in a higher demand, than during a time like this, an energy crisis. But ultimately, there's plenty of disruptive companies out there. But my focus would be on companies that don't need to burn cash for years on end, or run unprofitably because they need to keep the cost of their products low enough just to compete with their competitors and survive. We've seen that with companies like Uber or, food delivery service companies especially. Finding life-changing companies is certainly difficult, but the results could be extraordinary if you do. But yeah, that's going to be the end of the video. If you liked it, please remember to like, comment, and subscribe to the channel. Thanks for watching.